We've had some people call it a pipe dream, other people call it laughable, the amount of rate cuts priced in for 2024. Where are you on that one?
Well, our camp is that we still see a recession coming, and although our base case is a mild recession, and as a result, we still see rate cuts. And we are actually predicting that they start sooner rather than later. And I know now that's not exactly the mainstream opinion, but we see a lot of softness in the economy coming ahead, and that leads us to our outcome.
Where do you see that weakness right now? What's guiding you?
So I think there's really two economies happening in the U.S. right now. We have the established markets, the larger businesses, those with access to capital. And then we see the 50% of the GDP, which is small and mid-sized businesses. And that part of the economy, and particularly in manufacturing, is slowing down. We're having a bit of almost a rolling recession already. And as a result, I think there's real risk into what I would refer to as the real economy.
Is there going to be one moment where people sort of say, aha, we see the weakness, we understand why the Fed is cutting rates, and it is not because of a soft landing? Is it going to come from something like some of the regional banks, like what we saw last spring?
I'm very concerned about the regional banks. I'm not concerned about the large banks, the SIFIs. I'm very much concerned about the small and mid-sized banks. They've got several risks happening at this point in time. They've got commercial real estate and a refinancing wall in that space, and a refinancing wall in their commercial and industrial loans. And I think that this is going to cause them to have to, really take risk considerations very carefully. And I think the lending capabilities that they're going to have and the capacity that they're going to have to lend is going to be very limited.
From an investment perspective, how do you express this? Do you just avoid regional banks? Do you just avoid commercial real estate? Do you just pile into money market funds?
So as a fixed income investor, predominantly, it's a good time to buy investment-grade fixed income. The up in credit quality trade has been a good one. You certainly aren't being hurt with yields north of 5% in investment-grade fixed income. And even within the public high-yield space, the higher credit quality within that, the double-B rated and so forth, is performing well. We've seen spreads tighten. There's been less issuance in 2023. I expect that to continue in 2024. And so as a result, credit has been a popular place to be, and will be, I think, a very solid place to be in 2024.